Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
We're going to get an update now on just how the third quarter earnings season has been progressing with our research director, Shiraz Mian. And rather than ask you how it's been progressing, because people have been pretty disappointed overall, what I am going to ask you is, after the dust settles on Q3 and it's all said and done, will we at least be able to walk away with a sense of, well, we got by okay?
I think that's a fair statement, yeah. Not much growth was expected, and we are not getting much growth either. There have been a few pockets of strength. Some of that has been a positive surprise. But overall, no major bombshells. And I guess that would qualify for a sigh of relief. The overall picture is quite weak. There's no growth. Revenues are problematic. And if the markets have been held up, it's not because of earnings. It's because of everything else but earnings, yeah.
All right, so we haven't done this in a while. Let's run down the scorecard.
Okay, so I have a few slides to share with folks. We have 307 S&P 500 companies have reported results already as of this morning. And these 307 account for more than 2/3 of the index's total market cap. So we have a pretty representative sample for Q3 earnings season. Total earnings are up 1.8%. Total revenues are down 1.7%. 71.4% of the companies are beating earnings, and only 42.9% are beating revenues. As I mentioned earlier, technology, there have been some pockets of strength I mentioned. Technology, medical would fall in those positive reporters category.
Okay.
Retail, though we still have plenty of reports from that sector to come, seems encouraging. And energy, industrials, basic materials are on the weak side. This following chart gives, it's a table for the scorecard, all sectors, and full details. You could see at the bottom that on an ex-energy basis, the reported number would be slightly positive.
Okay.
And just to put those results in context, here we compare the growth rates we have now for earnings and revenue and the beat ratios we have now for earnings and revenue, and compare that to what we saw from that same group of 307 companies in Q2, and then the 4-quarter average. So any way you look at this comparison, this is weak performance, and the revenue weakness is particularly notable. There is no growth. It's a decline, and very few companies are able to beat even the lowered estimates. So all in all, a fairly weak picture, and even the modest earnings growth, once you strip out easy comparisons at Bank of America, it's even weaker. As you could see, the growth rate for the S&P 500 drops into the negative territory.
All right, and when you say this morning, we're sitting here talking about this on Thursday, October the 29th. So are margins a bigger key factor than revenues for investors to stay focused on here?
You know, revenues are the key driver where we stand now in the earnings cycle, starting where we did in 2009 and up to here. We made some major strides on the margins front. A big chunk of the growth that we saw over the last few years have come through margin gains, and even now, the companies that are able to maintain the earnings level is through cost cutting and being more disciplined on the expense side. But unless they can find a way to increase their top lines, there will not be any bottom line growth. So we can focus as much as we want on margins, but the margin levels right now in the aggregate are at levels that are above the prior cyclical peak.
Oh.
So there may be some modest room for margins to improve some more over the next few quarters. But overall, the best of the margin gains are behind us. The more optimistic view would be that margins stay stable. A realistic base case scenario would be for margins to start moving back down towards the mean, which is materially below current levels.
There have been some high-profile warnings through this earnings season, mixed in with some mixed U.S. economic data, mixed to maybe a little weaker U.S. economic data since the season began. Do these warnings provide any clue to the state of the U.S. economy?
They do. They corroborate what we are seeing in some of the top-notch economic reports. For example, most of the basic materials types of operators, whether they are the chemicals, the industrials, miners, and all those sectors that are exposed to the export market, those are struggling. And we know that from our economic data as well. By and large, the consumer is holding up decently. And key sectors of the economy like housing is doing good. Transportation, by and large, is doing good, particularly on the airline side. So it's a mixed picture of the U.S. economy. The portion of the economy that's more centered towards domestic consumption, that's doing better. The portion that's more exposed to the global economy, that's suffering, and that's what we see in the earnings results as well.
So what continues to be the biggest drag or drags on earnings?
Energy is the most obvious. We know that. We've been talking about that for a long time, and it's well understood by everybody. Beyond energy, there are a couple of things. As we briefly mentioned, the global growth is a big issue. And some of these major profit warnings that you refer to, like Caterpillar, like DuPont, like a number of other players, these are the operators who have very strong leverage to the health of the global economy. And a lot of the drivers that we see on the earnings front are tied directly or indirectly to the global growth picture. So that's a big issue. The dollar strength, as you know, has been an issue the last few quarters. It is a big problem in Q3 as well. And given the outlook for the Fed and the variance that we see between the U.S. Fed's trajectory and how our global partners' central bank policies are expected to unfold, the dollar strength will remain a big issue in the coming period as well. And then you mentioned margins. Margins have, as I mentioned, topped out already, so you don't really have a lot of room to grow those. These are all combined are the major drags on the earnings picture.
What about oil prices?
Oil prices, same as we have with the broader commodity complex. It's a function more of the demand, which is weak. So you have Brazilian recession. You have questions about China. Europe is improving, but not as much as one would like. And there are some doubts about the U.S. economic outlook as well. So the demand picture is uncertain. Supply still remains strong, and that's showing up in oil prices that are struggling to break above $50. And we see that the same forces in play in pretty much all of the economically sensitive commodities as well.
So that's another drag on earnings.
Absolutely.
Okay. So corporate guidance remains cautionary at best. What is that telling you about Q4?
It's telling me that the outlook for earnings growth remains weak, that the negative earnings growth we are expecting in Q3 will carry into Q4 as well. I have a slide.
Okay.
And what this slide is basically showing is how the earnings growth expectations for Q4 have evolved in recent weeks, particularly since the Q3 earnings season got underway and management shared those cautionary guidance and outlook with us. You will see that in mid-September, earnings were expected to be down 1.1% in Q4. They are now down to more than 6%. So a very accelerated decline in earnings estimates for Q4. In fact, by a number of measures, the magnitude of negative revisions I'm seeing for Q4 is higher than what we saw in comparable periods for Q3 as well as for Q2. So very strong negative revisions, and that's reflecting the negative guidance from management teams.
At this point, I won't even get into a discussion about the year as a whole yet. We'll save that for another time. Thanks, Shiraz. And in between these video updates on these peak times during earnings seasons, don't forget you can always get some commentary in written form from Shiraz on our website at Zacks.com. You can link to it off the homepage. On Mondays, he puts out his earnings preview and then updates his earnings outlook commentary, written commentary, periodically throughout the earnings season. And then day to day during the peak periods of earnings season, you can check out his Ahead of Wall Street column for day-to-day changes in his thinking and in other developments. With Shiraz Mian, I'm Terry Ruffalo.